It's a pleasure to be here today and share with you some of the fundamental principles that have guided me throughout my investing career. As we navigate the ever-evolving landscape of the stock market, it's easy to get lost in the noise, those daily fluctuations, the media hype, the constant chatter. But if there's one thing I've learned over the decades, it's that successful investing isn't about how much noise you can make or how fast you can move. Rather, it's about understanding the essence of what you're doing when you invest your hard-earned money. I want to share with you today 3 essential rules of investing, rules that, if followed, can help you navigate the market with a clearer mind and a steadier hand. These rules are simple, but don't mistake simplicity for lack of importance. In fact, their simplicity is what makes them powerful. Let's dive right in. Rule number 1, a stock is part of a business. This is the cornerstone of all intelligent investing. When you buy a stock, you are buying a piece of a business. This is not some abstract concept or a mere paper certificate that entitles you to some vague ownership, right? No, you are buying a real slice of a real enterprise with real assets, real employees, real customers, and, most importantly, real potential for growth or failure. Let me illustrate this with an example. Imagine you buy a small stake in a local bakery. You'd probably want to know a few things before handing over your money. You'd want to know about the bakery's location, its reputation, the quality of its products, the competence of the baker, the trends in the neighborhood. Is it growing or shrinking? You'd also want to know how the business is run, whether it's profitable and what its prospects are for the future. If the bakery does well, your share of the profits grows, and if it doesn't, your stake might diminish in value. Now, apply the same logic to stocks. Every time you purchase a stock, you're investing in a business, whether it's Apple, Coca-Cola, or a smaller company you've never heard of before. The price of the stock represents a piece of that company's future. Therefore, you should evaluate stocks as you would if you were going to buy the whole business, or at least a significant part of it. Don't get lost in the daily fluctuations of stock prices. Instead, focus on the long-term performance of the business behind that stock. I've often said that you should buy a stock with the intention of holding it forever. This doesn't mean you will literally hold it forever, but it does mean you should only buy a stock if you believe in the enduring value and growth potential of the underlying business. The value of your investment will follow the fortunes of the business, not the whims of the market. Rule number 2, most people react too much to their stock's value. In the world of investing, emotions can be your worst enemy. The stock market is a device for transferring money from the impatient to the patient. And nothing fuels impatience like the constant stream of prices, news, and opinions that bombard investors every day. One of the biggest mistakes investors make is to overreact to the fluctuations in their stock's value. Every day, the market presents you with a price for the stocks you own. Sometimes those prices make sense, and sometimes they don't. The stock market is there to serve you, not to instruct you. If you let the whims of the market dictate your actions, you're bound to make irrational decisions that will harm your long-term results. Consider this. If you own a farm, do you check the price of your farm every day? Do you worry about its value each time the weather forecast changes? Of course not. You focus on the long-term productivity of your farm, the crops it yields, the improvements you can make to increase its value over time. You know that overreacting to short-term fluctuations in farm prices would be a mistake. Similarly, with stocks, it's important to stay calm and focus on the fundamentals of the business. I've seen countless investors sell in panic when their stock's price drops, only to watch the stock recover and exceed its previous highs. I've also seen people buy into the hype when a stock is soaring, only to see it plummet soon after. Reacting emotionally to stock prices is a sure way to diminish your returns and increase your stress. Remember, the market is there to serve you. If it offers you a great price for something you want to sell or buy, take advantage of it. But if it offers a ridiculous price, be it too high or too low, you're under no obligation to act. Often, the best thing to do is to do nothing at all. Stay focused on the long-term value of your investments and let time do its work. Rule number 3, margin of safety, don't be too risky. The third rule is one that Benjamin Graham, my mentor, hammered into me when I was young. It's the concept of the margin of safety. In simple terms, this means that you should never bet the farm on any investment. Always leave yourself a margin of safety so that if things go wrong, and they often do, you won't be wiped out. When you buy a stock, or any investment for that matter, there's always a degree of uncertainty. The future is inherently unpredictable, and even the best business can run into unexpected problems. That's why it's crucial to build a margin of safety into your investments. This might mean buying stocks at a discount to their intrinsic value, diversifying your investments, or avoiding overly complex and risky financial instruments. A good analogy is building a bridge. If you know that the maximum weight that will ever cross the bridge is 10,000 pounds, you don't build the bridge to hold exactly 10,000 pounds. You build it to hold 15,000 or 20,000 pounds to ensure that it can handle unexpected loads. Similarly, when you invest, you want to ensure that your portfolio can withstand unexpected shocks. This margin of safety is what protects you from the unknown. It allows you to sleep at night knowing that your investments are not hanging by a thread. If you invest with a margin of safety, you're less likely to make impulsive decisions based on short-term events, because you know that your investments have the resilience to weather the storm. And here's the critical point. If you think you might lose money, don't invest. It's as simple as that. There's no shame in sitting on the sidelines if you believe the risks are too high. The stock market is full of opportunities, but not all of them are worth the risk. It's better to pass on an investment than to jump in without a sufficient margin of safety. Remember, the goal is not just to make money, it's to avoid losing money. These 3 rules: a stock is part of a business, most people react too much to their stock's value, and always maintain a margin of safety, are not just abstract ideas. They are the bedrock of sound investing. If you internalize these principles, you'll be better equipped to navigate the stock market, avoid common pitfalls, and build wealth over time. Investing is as much about temperament as it is about intellect. You don't need to be a genius to follow these rules, but you do need the discipline to stick with them, even when the market tempts you to do otherwise. The market will always fluctuate, but if you remain steadfast in your approach, focusing on the long term and avoiding unnecessary risks, you'll find that your investments will grow in value over time. I've been investing for a long time, and if there's one thing I've learned, it's that patience, discipline, and a firm grasp of these fundamental rules can make all the difference between success and failure. I encourage you to take these lessons to heart, and I wish you all the best in your investing journey.